Is the Singapore market a safe haven, or are we just asleep at the wheel while the rest of Asia burns? That is the question on everyone's mind today. We are seeing red across the region. We are seeing uncertainty. And yet, right here at home, the Straits Times Index is refusing to budge. It is sitting there, stubborn, calm, and seemingly immune to the noise. But here is the danger. When a market goes quiet, many retail investors mistake that silence for safety. They think nothing is happening, so they stop paying attention. They stop looking at their portfolio. They assume steady means safe. But if you dig just one layer deeper, if you peel back the curtain on today's trading session, you will see that while the index itself is flat, the battle beneath the surface is raging. We have a massive divergence happening right now. On one side, we have real estate investment trusts having their best run since 2019. On the other side, we have income favorites cutting their payouts by nearly 6%. And perhaps most importantly, we have our biggest bank trading at a price that might just be a little too perfect. So, if you are a retiree relying on these dividends, or if you are looking to park your cash somewhere safe, how do you read this? Is this resilience, or is this the calm before a storm? We need to look at the numbers because the headline doesn't tell the full story. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and tell you exactly what matters for your money. I want to welcome the 22 new paid subscribers who joined us on Substack this week. Thank you. Small wins matter, just like those dividends hitting our accounts. If you are new here, welcome to the tribe. We are building a community of informed investors here, one video at a time. Today, we are going to break down the daily digest for the 10th of December, 2025. We are going to look at the index, the surprising rally in REITs, the hard truth about Mapletree Industrial's payday, and the war between our local banks, specifically why DBS might be flashing a warning sign despite the hype. Let's start with the big picture, the market snapshot. The Straits Times Index, or the STI, nudged higher today, closing at 4,513 points. That is up about 6 points, or 0.1%. Now, on the surface, a 0.1% move sounds like a rounding error. It sounds boring. You might look at that and think, Iggy, why are we even talking about this? Nothing happened. But let's pause and look at the trading range. The index moved between 4,503 and 4,520. That is an incredibly tight range. Why does that matter? When you see a tight trading range like this, especially when other regional markets are volatile, it signals consolidation. It means investors are not panic selling, but they are not aggressively buying either. They are holding their ground. For a Singaporean investor, especially someone in their retirement years, this is actually a very bullish sign. It tells us that the floor at 4,500 points is solid. It is holding. If the market was weak, we would have seen a test of 4,400 today given the regional sentiment. We didn't. We stayed above 4,500. That level is now our line in the sand. Now, let's move to the biggest story of the day. The sector that is finally waking up, S-REITs. If you have been holding onto your real estate investment trust through the pain of the last 2 years, I want you to give yourself a pat on the back. Seriously, you earned this? The iEdge S-REIT Index is currently clocking a 14.7% total return year to date. Let's stop there. I use the term there that I want to define clearly because it is crucial for your understanding of performance, total return. When we talk about the index being up 14%, we are not just talking about the price on the screen. Total return combines two things: capital appreciation, that is the price going up, and the dividends you received and reinvested. So why does this matter to you? If you only look at the stock price, you might think your portfolio is flat. You might think you made no money. But when you factor in the dividends, you are up nearly 15%. That is the power of income investing. This is the best year for S-REITs since 2019. The narrative has shifted. For 2 years, the story was fear. Fear of interest rates, fear of refinancing. Now the story is recovery. Falling funding costs and stable occupancy rates are finally filtering through to the bottom line. So here's the rhetorical question you need to ask yourself. Is this a trap? Is this a dead cat bounce? My take is no. This is a fundamental shift. The rate cut narrative is no longer just a hope. It is feeding into real returns. But, and this is a big but, this is a blue chip rally. This isn't a tide that lifts all boats. The quality REITs with solid occupancy are flying. The trashier REITs with high debt are still struggling. So do not just buy anything with the word REIT in the name. Stick to quality. Speaking of quality, let's talk about the second big story, Mapletree Industrial Trust. Today, the 10th of December is payday. If you are a unit holder, the cash should be hitting your bank account today. It is always a good feeling to see that notification. But we need to have a sober conversation about the numbers. The distribution per unit, or DPU, is roughly 5.6% lower year on year. Let's break down DPU. Distribution per unit is essentially your dividend paycheck. It is the amount of cash you get for every single share you own. When we say it is down 5.6%, that is a direct pay cut. Now, so what? Why should you worry about a 5% drop if you are still getting paid? Think about it this way. If you are a retiree living off this income, your costs of living, your TRIPNG, your utilities, your transport have all gone up due to inflation. At the same time, your paycheck from Mapletree has gone down by 5%. That is a double whammy. Your purchasing power is being squeezed from both ends. The reason for this drop is exactly what we have been warning about. Higher interest rates from the past year are still nibbling at margins. Even a blue chip name like Mapletree Industrial isn't immune. So what should you watch for? The metric to watch here is the interest coverage ratio. This measures how easily a company can pay interest on its outstanding debt with its current earnings. We want to see this stabilize. Enjoy the payout today, go buy yourself a nice lunch, but keep a hawk eye on the next quarterly report. We need to see that DPU stop sliding. Now let's move to the heavyweight battle, the banks, DBS versus UOB. The divergence here is getting extreme. DBS is trading near record levels. It is the golden child right now. It had a stellar Q3 fueled by wealth management fees and service income. On the other hand, UOB is in the penalty box. Its price is lagging. The market is worried about its asset quality, specifically the provisions for its China loan book. Let me explain that term, provisions. When a bank makes a loan, there is always a risk the borrower won't pay it back. A provision is money the bank sets aside today to cover a loan that might go bad tomorrow. It is like an emergency fund. When UOB increases its provisions, it eats directly into their profits. That is why the market is punishing them. But here is where things get interesting. The market loves a winner, and right now, that is DBS. It is the safe haven trade. It feels comfortable to buy the winner. But my job is to ask the uncomfortable questions. Is it too expensive at these all-time highs? I didn't just guess at these numbers. I checked the Investing Pro models, and frankly, they are flashing a warning. Is the bank overextended? Let's look at the fair value models. Right now, DBS is trading at $54. But the Investing Pro fair value sits lower at $50.29. That means we are looking at a 7% downside risk. It is officially trading at a premium. Now, I know some of you might be looking at the financial health scores on the platform and freaking out because you see a scary red cash flow score of 1. Let me stop you right there. Do not panic. Automated models often flag banks as burning cash simply because they are lending money out. Think about it. When a bank gives a loan, cash leaves the bank to a simple algorithm that looks like negative cash flow. But for a bank, that is literally their business. So ignore the cash flow score. Look at the profitability health instead. It is solid, but here's the conflict. The analysts, the humans at the big brokerage firms are hype-driven right now. They are targeting $56. The Investing Pro model, the math, is conservative, targeting $50. So who do you trust? The hype or the math? I prefer to trust the math. The upside is capped here. If you want to run these numbers on your own portfolio, stop guessing. I have arranged a special deal for you on Investing Pro, the same institutional data I used in this video. You can see the fair value, the financial health scores, and the dividend safety checks. Use the link below with code Investing Iguana for up to 50% off. It is the best investment you will make in your own education this year. The verdict on DBS, the bank is healthy, but the stock is expensive. I would not chase it at $54. Put it on your watch list and wait for it to touch that $50 fair value line before you back up the truck. Now, let's look at what the analysts are saying, specifically CGS-CIMB. They aren't changing their tune. They have reiterated DBS as their top pick. Why? It comes down to one number, ROE, return on equity. Let's define that. Return on equity measures how efficiently a company uses shareholder money to generate profit. If I give the bank $1, how much profit do they generate from it? DBS has an ROE above 16%. That is world-class. OCBC is in the low teens, UOB is below 10%. So what does this mean for your money? It means for every dollar you invest in DBS, the management team is generating significantly more return than the team at UOB. That is why DBS commands a premium. That is why it is at an all-time high. The market pays for efficiency. So is UOB a value trap? A value trap is a stock that looks cheap but keeps getting cheaper because the business is deteriorating. UOB looks cheap, but cheap can stay cheap for a very long time if those provisions regarding China keep rising. If you're looking for momentum, the train is leaving the station with DBS, but as we just discussed, the ticket price is getting very high. Let's wrap this up with the verdict for the day. What is working right now? Stability is working. The STI holding 4,500 is working. And the top tier S-REITs are working. We are seeing a flight to quality. Investors are rewarding companies that can navigate high costs like DBS and the blue chip REITs. What is not working? Lagging banks and lower tier industrial trusts. The market has no patience for uncertainty. If a company has asset quality concerns like UOB or falling DPU without a clear turnaround plan, the market is punishing them. So, what is the play for tomorrow? If you are a new investor, be careful with DBS. Great company, expensive price. Do not chase it here. Wait for a pullback to $50. If you are an existing investor holding UOB or Mapletree Industrial, do not panic, sell. Hold. Collect your dividends, but watch those quarterly reports like a hawk. You are waiting for the narrative to change. Tomorrow looks like a steady as she goes day. Check your bank account for those Mapletree dividends. Decide if you are going to reinvest them or treat yourself to a nice lunch. Watch DBS. If it breaks out further, it could pull the entire index higher, but be wary of the valuation gap. And remember, staying calm is a strategy. The fact that we are holding steady while Asia is red is a win. If you want to dive deeper into the charts and get my full watch list, make sure you check out the Substack. And if you are serious about analyzing these companies yourself, grab that Investing Pro subscription with the code InvestingIguana. I am Iggy. Thanks for watching, and I'll see you in the next analysis.